Okay, let's dive right into this explainer. Today, we're looking at a fascinating dynamic detailed in a recent expert report, specifically how the system clearly separates those who bleed capital from those who preserve it. We aren't treating the tax code like some boring list of rules here. No, it's an explicit framework built purely on cause and effect. We're going to put our analytical lens right on one critical mechanism today: how deploying Section 162A can turn your everyday expenses into a legal shield, and why, honestly, staying a W-2 employee could literally cost you a fortune. So I want to kick things off with a fundamental question. Why exactly does your classification determine your financial friction? If we peel back the surface level assumptions about, just earning a living, we hit a structural reality. The system does not tax all income equally. It taxes the actual method of your income generation. The legal classification you operate under absolutely dictates the exact moment the government takes its cut. This brilliantly illustrates that core dichotomy. If you're stuck in the W-2 formula, your gross income is instantly slashed. Federal, state, payroll taxes, they all take a bite before a single dollar even hits your bank account. It's incredibly frustrating, right? But look at the business formula. It legally reverses those final two steps. You earn, you spend on your operational needs, and then you're only taxed on the margin that's left over. Let's be clear, this isn't a loophole. It is the mathematical reality of the system. All right, here is our roadmap for today. 1. The W-2 tax trap. 2. The business owner advantage. 3. Decoding Section 162A. 4. Everyday expenses as deductions. 5. The self-employment tax penalty. And finally, 6. The S-Corp optimization. Section 1. The W-2 tax trap. We really need to look beyond just the paycheck to understand the true financial vulnerability of being an employee. The crucial point here is that almost all unreimbursed employee expense deductions have been wiped out by recent tax laws. This means you have almost zero statutory leverage to lower your taxable income. Back in the day, employees had minor flexibilities to write off out-of-pocket work stuff. But according to current statutory analysis, those have been severely restricted or just completely erased. As a W-2 earner, your income is fully exposed. You literally lack the legal mechanisms to offset your income with the expenses required to generate it. You are just absorbing the maximum amount of friction the system can possibly apply. Section 2. The business owner advantage. Let's contrast that W-2 trap with the environment actually designed for those who take on financial risk. Listen to this, because it's important. This isn't about shady loopholes, it's a fundamental cause and effect relationship. The government explicitly rewards the assumption of business risk with accelerated write-offs and expanded deductions. The expert report we're analyzing makes it crystal clear. The economy completely relies on job creation, innovation, and infrastructure. Because a business owner risks their capital to provide those exact things, the tax code protects them. It is a highly calculated policy choice. When you shift your classification to a business owner, you're aligning yourself with the government's economic incentives, which officially unlocks your ability to legally protect your capital. Section 3. Decoding Section 162A. To understand exactly how these write-offs work legally, we have to decode the foundational mechanism, Section 162A. Think of this as the analytical tool you absolutely must leverage to turn daily expenses into tax write-offs. This single section of the tax code is the literal dividing line between those who pay taxes on gross income and those who pay on net profit. It's your explicit authorization to subtract the cost of doing business from your revenue way before the government calculates below that. Now, what's truly fascinating here is how strict yet surprisingly flexible these legal thresholds are. An expense doesn't need to be life or death vital to be deductible. It just needs to fit 3 criteria. Ordinary just means it's common and accepted for your specific industry. Necessary simply means it's helpful and appropriate for generating income. And reasonable ensures you aren't wildly inflating your costs. If you meet these 3 pillars, a sunk personal cost transforms right into a protective business asset. Section 4, Everyday Expenses as Deductions. Let's see how this statute applies directly to the stuff you use every single day. Consider how this breaks down. The law easily accounts for partial use assets. This means if you can prove through solid documentation that 65% of your smartphone usage is for business, well, you legally deduct 65% of its cost. You don't need to go buy a secondary dedicated burner phone. The system completely acknowledges the modern reality of blended assets. So by carefully tracking and prorating the business usage of your laptop, cell phone, or internet plan, you shield a calculated percentage of that expense from taxation. It's that simple. But, and this is a big but, there are very strict substantiation standards required by tax authorities to actually claim these deductions. Whether we're talking about a software subscription or a business meal, the burden of proof is entirely on your meticulous documentation. Meals, for instance, typically offer a 50% deduction, but they demand rigorous proof: date, location, who was there, and the exact business discussed. The home office deduction, that requires the space to be exclusively and regularly used for business. No blended personal use allowed there. And your digital subscriptions, if they pass that ordinary and necessary test we talked about, they are deductible based on their business usage. Your leverage here relies 100% on your discipline in tracking it. Here is a wild number for you. For 2026, the standard mileage rate is exactly 72.5 cents per mile. Instead of hoarding gas receipts and complex depreciation schedules in a shoebox somewhere, you simply maintain a meticulous mileage log. Say you drive 20,000 business miles. That transforms into a massive $14,500 deduction straight off your taxable income. Talk about a tremendous example of statutory optimization. Section 5, the self-employment tax penalty. Here is where things get tricky. Simply stepping out of the W-2 structure and into a basic business entity introduces a very dangerous, non-obvious trap. See that massive 15.3%? That represents the self-employment tax burden, which covers Social Security and Medicare, and it flatly hits the net profit of a standard default LLC. When you're a W-2 employee, your employer actually pays half of this. But the second you become a self-employed business owner, guess what? You become both the employer and the employee, and you are hit with the entire 15.3% burden yourself. Ouch! So if your consulting business nets, say, $120,000, you are bleeding nearly $17,000 to this specific payroll tax alone, and that's completely independent of your standard federal and state income taxes. The crucial takeaway here is that a default single-member LLC is merely a legal structure for liability protection. It is not a tax strategy on its own. As your profit scales up, this 15.3% tax becomes an aggressive compounding penalty that seriously degrades your working capital. Section 6, the S-Corp optimization. How do we fix this? Well, to bypass this aggressive structural penalty, we have to deploy an advanced tax classification mechanism. By electing S-Corp status, we fundamentally bifurcate or split the income. You pay that 15.3% penalty only on the base salary portion, completely shielding the remaining distributions from that tax. This right here is the absolute cornerstone of advanced small business tax strategy. Now, tax authorities do mandate that the salary you pay yourself must be reasonable for the work you do. But whatever profit remains above that reasonable salary, that goes to you as a distribution, legally exempt from that 15.3% tax. Let's look at the mathematical reality of this optimization. If that same $120,000 net profit is run through an S-Corp, and you take, let's say, an $80,000 reasonable salary, the 15.3% tax only applies to that $80,000. The remaining $40,000 in distributions is shielded, instantly preserving over $6,000 in capital. That, my friends, is the analytical power of structural optimization. It's a real game changer. So what does this all mean for you? I'll leave you with this provocative question to analyze regarding your own strategy. Are you bleeding capital to structural W-2 inefficiencies? Or are you strategically structuring your entities to protect your wealth?
Understanding these mechanisms isn't just about compliance. It's about mastering the leverage required to keep the money you actually make. The tax code is a rulebook that rewards precision, structure, and risk. By wielding Section 162A and optimizing your entity classifications, you transition from someone who bleeds capital to someone who purposefully controls it.